Let me give you the 10 best price action signals, entries, and tips that I have learned over the last 15 years being mostly a price action trader. The first concept is called capitulation, and we're going to take a look at it in the context of a double top. And as you will see in this video, we're going a little bit more advanced and not only cover the common, most basic price action signals. So here we see a bullish trend, and first of all, it's very important to understand how trends evolve and move. And you will always see that the price is going up and down, back and forth. We call the moves into the trend direction impulsive, and the phases where the market is not advancing but going sideways or pulling back a little bit, those are called corrective waves. And in the trend, it's very common to see that you have consolidation sideways periods. However, when such a sideways period takes longer than usual, so here at the right, at the top, you will see the market is in a very long-term sideways range. Often, this is then leading into a distribution. It's not a corrective wave, and the continuation is not very likely at this point. In a healthy uptrend, you want to see short-term consolidations where the market is spending a little bit of time going sideways and then advancing back into the initial trend direction. However, if the sideways phase takes too long, that's not a good signal for the ongoing trend. When we zoom out, we can see that this phase here is happening just right underneath a very, very important resistance level. Those levels, they work like magnets. The price is often pulled into those areas. And if I see the market is hovering just underneath such a big level, I would be very cautious. At that point, I would not go short, even though right now with the distribution, there are a lot of things speaking for more shorts coming. But I would always wait to see what the market is doing here. A few candles later, you can see that the market is shooting up, and within just a few candles, we are moving back within the pattern. So we are just back below the resistance. This is what we call capitulation. The market is trying to advance, trying to make a breakout, but it is a violent rejection, very, very strong move, and the market is not able to stay above that. If you see such a quick rejection, some traders may also refer to this as a trap or a fake out. There are many names floating around. This is a strong sign of weakness, especially if it happens in this context of where we have already seen such a long sideways consolidation or distribution. And afterwards, this is the capitulation, this is the big level, and afterwards you can see this is where the trend rolls over. So here we have the long-term distribution, which already makes the continuation less likely. The market is pulled into this level, it works like a magnet, and then you can see we're shooting higher, and then violent rejection, and afterwards the market rolls over. This is a classic concept that you will find time and time again. Next, let's talk about head and shoulders, but in a continuation context. And what we see here is that the market is overall in a bearish trend. So we're making lower lows and lower highs. And then we have a pause here. And this is our head and shoulders. We have the left shoulder here. We have the high here. This is our head. And this is our right shoulder. If you've been watching my other videos, I will refer to this as a lower bounce. Why is that so? Because just look at how the market is responding to this low. Whereas previously the market moved into this low and shot up higher, the market comes back to the exact same low, but this time we have just a very minimal reaction. So not a lot of bullishness. This is a very, very great precursor for more bearishness to come. We are not going to predict what happens. We still have to wait for the market to clear this neckline. However, this is a very, very good indication that there's not more bullishness in the market and the bears seem to be taken over. Also, it's very important to see how the market reacts at the head. You have a strong reaction here, the strongest reaction that we have seen in all of this sideways period, in all of this bearishness even, but you can see the market is not able to follow through. We are falling back, right back into the previous support level. Also capitulation, which basically means the buyers are not able to advance the market further. The bears are in full control here, and the bears are the clear majority. And we have the breakout. This is where you get in. You never get in as long as the market is above the neckline. You have to wait for the market to clear those areas because there is still a chance the market will bounce higher. And we want to make sure that we have the odds in our favor. Of course, the market could still turn around, but at this point, the odds are way more in our favor than if we would trade short here. Stop-wise, typically you want to put your stop loss above the lower bounce high, so above the right shoulder. You don't have to put it all the way up here, but just above the right shoulder, and then you can see afterwards realizing a continuation with a good reward to risk ratio is often likely. Next, let's talk about the triple tap. It's an exhaustion pattern. And recently I published a new strategy ebook, which you can download for free at tradeciety.com/newsletter. The link is also in the video description and in the comments. And you can get instant access to this triple tap strategy guide ebook. I talk about different variations of the triple tap. I show you exactly how to get into those trades. And I also have a few tips on add-on patterns and how to make this triple tap work even better. Also, when you subscribe to the newsletter and download the ebook, you will also get a new email from me every Thursday directly into your inbox with new trading tips and insights that I've never shared anywhere else before. So it's a private email newsletter, and I really highly recommend it if you're enjoying my videos, because I go more in depth and have new tips that you haven't seen before. But let's take a look at the triple tap. And the triple tap in this example, the key here is the long mature downtrend. For any exhaustion pattern, the key is always the trend maturity. The longer a previous trend has been going on, the higher the likelihood that at one point, given the right circumstances and given the right signals, you will have a reversal. So let's focus and zoom in here on this part, which is our triple tap. And what we see here is weak lows. And the term tap in triple tap refers to the lows. And you can see when we just look at the distribution and the distance of the lows, here's our low and here's then the following low. But you can see the distance is obviously very small. And then from here to here, the price is almost not able to make a low at all. We pretty much just have the wick pointing through it. So you could also say this is a double bottom with a fake out. So we have a lot of weakness at the lows. And at the same time, we have strength at the bullishness. So you can see here, we have strong buying power. If we zoom out, this buying leg is the strongest buying phase that we have seen in all of this downtrend. Whenever you see weak selling, strong buying in the right context, with the triple tap and in the context of a mature trend, that's a very, very important market tell. And afterwards, not always, but very often you will see a reversal. And you can see this is the strong buying, this is our weak bottom. And afterwards you have a very, very strong bullish push. This brings you above the recent highs. This is usually taken as an entry on the triple tap. You can play them with breakouts or break-in retests. And afterwards the market rolls over. So triple taps in the right context are really, really powerful patterns. So make sure to check out the link in the video description if you want to get more information about the triple tap with my ebook. Next is the liquidity run, and we're going to take a look at the concept of deceleration at the same time. So what we have here is the higher time frame, and the higher time frame is running into a very, very important level. What I would always recommend on your charts, go to the higher time frames, the 4-hour, the daily, even if you are a day trader, and mark those important turning points. If a level has been acting as support or resistance in the past and has led to a huge market shift from an uptrend to a downtrend or from a downtrend to an uptrend, mark them on your charts and see how the market reacts to them again in the future. So we want to zoom in and see what is going on here. And this is a classic deceleration acceleration pattern. When you look at the classic candlestick names, this is referred to as a morning star or an evening star. The key is here the strong buying power, then you have the neutral candle, the doji or inside candle, and then you have strong selling coming into the market. This is what we would call a deceleration because the market is first slowing down, and then acceleration because the market is advancing and accelerating into the opposite direction. At this point, we go to the lower time frame, and this is how it looks. This is the fake out here, also very strong rejection. Very important to understand and look at the market behaving at those key levels. This is the big level. And if you see you have such a strong rejection here back into the pattern below the range, that's a very, very important tell. Also, the distance between the highs is important. The price after trying to break out was never able to get close. We are not even able to get above this level here, 859. Very strong resistance, and the buyers at this point don't have the majority anymore. The buyers are not able to get the price above this area. We have the breakout and the first bearish leg. And there is another pattern that I will later show you. What I've observed over the last few years is that after this first bearish leg, there's a high tendency for the market to push back into what we could call the stop zone. Because think about it, the traders who trade the breakout here, where will they have their stop loss? Somewhere in this area, and therefore stop runs are really, really likely, and they occur very often to free up this additional liquidity. And you can see the advance after the breakout, it can sometimes last for many candles, but waiting for this liquidity to run could be a whole strategy in and of itself. So if you're not comfortable trading breakouts or you want to add to your repertoire, then try to study those areas. Those liquidity runs in the stop zone, they often come with a lot of volatility here, and afterwards there's a high tendency for the market to pull away and fulfill the path into the direction away from the big resistance level. So a really fascinating pattern overall. Cup and handle as a pressure pattern, let's see what this is. So what we have here is a mature trend, and then the market puts in this high here. We have the resistance here, then the market pulls away, we have another resistance here, and after this high, the market is not able to really get away. The market is really sticking to the level. We could call it a lower bounce, or in this case, maybe a better word would be the higher bounce, because the market is always coming back into the level sooner and sooner. Especially here, you can see the market is not able to get away from this level at all, which suggests a lot of buying interest and not too much selling interest. Then afterwards you have the breakout and the quick run upwards. Generally speaking, just like in the example of the head and shoulders, the stop loss is usually placed below the last low. However, the context here is really the key for your trade projection. The market has been already moving higher for a long time, and you can see the market has been trading sideways for a long time. Remember the first example where I told you that long consolidations in a mature trend often are more of a distribution and a reversal is very likely. This is also very important if you want to structure your trades. If you find a buying opportunity in such a market, yes, there's still maybe an edge and you could still trade the market higher and look for a buying opportunity, but you don't want to stretch your target too far. You want to generally be quickly in and out of the markets. Don't hold or don't try to swing for the fences. Don't hold the trade too long, because the longer the market has been going on with a long distribution pattern, there is a high chance that the market is maybe also just giving you this capitulation, the market quickly shooting up higher and then violently being rejected. Another example in a different trend context with the cup and handle is the origin cup and handle. And here we have a completely different picture and really fascinating to compare those two. Here, the cup and handle is shown in a mature downtrend. The market has been moving down for a long time, obviously, and then we are bottoming out. So in this case, we could look at the cup and handle as part of an accumulation pattern, where the powers shift from a seller-oriented market to a more buyer-oriented market. You also can see a volatility increase, and volatility often increases at market turning points. And this is a very important and a fascinating topic to actually study. What you will see is that during a regular, modest, healthy downtrend or uptrend, the candles are relatively small, there's not a lot of back and forth, and a trend usually advances moderately. However, when you see an increase in volatility, this could be much larger candles, a stronger back and forth, long candlestick wicks poking and sticking out to both sides. This is what we refer to as an increase in volatility. And at turning points, when the sellers are getting out and new buyers are coming in, and there's a lot of back and forth, that's where you can often see this increase in volatility. So this could be a great add-on for your price action trading to just monitor volatility levels. And when we zoom in, this is what the cup and handle actually looks like. So the cup is a rounded pattern. You can see that we have a resistance pattern here. Then we have a resistance here. And then after the market hit this resistance again, we are moving away lower. And it looks clearly like a cup, right? This is the cup, this is our little handle, and it's a pressure pattern. After this area was hit, after the resistance, the market didn't pull back quite a lot. The market really stuck to this area. And this is our pressure pattern. And it's very important to study how price behaves around important swing highs and swing lows. Is it pushed away very far? Is the market not being able to push away very far? Is it really sticking to the level? How quickly is the market coming back to the area? Those are very important market tells. And in this case, it's a very bullish signal because first of all, the market was not able to push away far. And we are back at the same area very quickly. This is a very different picture to what has happened before. Very classic bullish breakout scenario, and then we advance higher. In this case also, what is important to understand, in contrast to the other previous example, is that here we're looking at a potentially new trend. We are very early on in a potentially new uptrend, whereas in the previous example, This is an already mature uptrend, and the upside potential is much, much lower compared to if we catch a new bullish trend. So here, if you are getting into the origin of new trends, you may be able to stretch your targets much further. And then here, along the way, you can see we have an inverse head and shoulder continuation, which could be another signal that we have discussed in this video as a continuation trade. The classic 1, 2, 3 pattern is also more of a reversal pattern. And what we have here is a mature downtrend. Then we kind of have a double bottom, whereas the second low is a little bit higher than the previous low. So a little bit of bullishness. But the key of this pattern is here really the momentum shift. And whereas previously in the downtrend we don't have a lot of bullishness, this changes down here. We suddenly have a strong bullish push here, but the key is this push. The first bullish trend wave that is breaking a previous high point. We're also breaking the trend line, but the key is breaking really the swing point. When you see that bullish trend waves suddenly are much longer than bearish trend waves, and the bearish trend waves here are much shorter than what we've seen in the past, that's an important criteria that something behind the scenes, behind the buyers and the sellers and how they interact and how they're positioning themselves is clearly changing. Now we have way more buyers. And the classic 1, 2, 3 pattern, we are starting to count at the origin of the first trend wave here, the first bullish trend wave into the opposite trend direction. Then point 2 is the end point of this trend wave. And then traders looking for trend continuations are looking for the point 3, which is the retest. And retests can happen at many different points. For example, we could see a retest of the trend line. We could see a retest of the previous highs and lows. We could also use a 50-period SMA, which is a great trend tool or trend filter. And very often, if you see those clusters, that's where you can often see great retests. This is then our point 3. So we have previous resistance turns into support. If you zoom in, you can see we have deceleration, acceleration. We have 1, 2, 3, 4 candles with wicks poking to the downside, but each candlestick wick is rejected, or each candlestick is rejected. That's why we leave the wicks here. It's a strong rejection signal at the perfect area. Then we have acceleration. The market is accelerating away from the support level. This is a very strong bullish buying signal. And following, this is where you have the trend emerge. So here is our 1, 2, 3 pattern. You could also work with the Fibonacci here. The key is the rejection, the deceleration, and the acceleration, and also the increase in bullish trend waves, the shortness of the bearish trend waves. And this is the key point in most trade and price analyses, that you look at volatility levels, you look at trend strength, at wave size, and this gives you a very clear picture of what is going on. And also the momentum shift is a great pattern that we can use here. So what we have is a strong bullish trend. Then it seems like we have the first strong bearish trend wave here. Very strong bearishness in the market, much stronger than anything that we've seen in the past. Here's our breakout level. A lot of traders who trade breakouts probably will have their stop loss somewhere up here. Then we have the immediate reversal back into the breakout level. And this is a pattern that I've been studying for the last maybe 2 years, because I've seen this tendency increase in today's market, 2023, significantly. And this is something that I would really urge you to also take a look at closer. After you see this strong initial selling, wait for this slingshot move. The market is pulling back, often also very strongly, back into the pattern, not able to get close or all the way back into the absolute high. That's also very important. So we have a lower high, but there's a strong reaction away. So after I see a market giving us a new impulse that we have not seen in the past, that is going on against the ongoing trend, so very clear that the market is shifting, I wait for this slingshot move back into the pattern, and often you will see that the market completely rolls over afterwards. So this is a great trend pattern as well. We can learn a lot about momentum studies here and volatility as well as the market rolls over. And again, don't forget to check the link in the video description, tradeciety.com/newsletter. Get the free ebook. You can download it right away. And then every Thursday, you will get a new email from me with new trading tips, new trading insights. And don't forget, every Tuesday, you also get a new video here on the TradeCiety YouTube channel. Thank you for your support, and you will hear from me shortly.